Gentlemen, on behalf of the WZCC Chamber of Commerce Pune chapter, it is my pleasure to welcome you to the webinar on Where Not to Invest by our guest speaker, Mr. Rishi Gupta. I request our chapter chair, Mr. Temas Barucha, to address the participants.
Thank you, Ulla. So, guest speaker of the evening, Rishi Gupta. Participants of today's webinar arranged by WZCC Chamber of Commerce Pune chapter, our friends from Lions, Rotary, Innerville clubs, members of WZCC Pune chapter, our global president, Mr. Edel Davar, our India region chairman, Captain Percy Master, our directors, Mr. Rustam Engineer, local directors, members from Mumbai and Bangalore chapters, ladies and gentlemen. I hope I am audible to all of you. Am I audible?
Yes.
Yes.
Okay. It's my pleasure to welcome you all today evening for the webinar on the topic of investment. You must have noticed that the topic is a little unusual. Generally, we have the talk on where to invest, what to invest, and how to invest. This is where not to invest. So that's very interesting. We all human beings, whichever part of the globe we belong to, we are very eager and anxious to make our money grow so that we can improve our standard of living. We are in a hurry for that. Now, the success or otherwise of this depends on various factors, of course, that our speaker will elaborate later on. But in brief, I would like to state as the financial assets fluctuate in value, one should conduct the due diligence and make informed decisions as opposed to instinct or emotions. There are certain mistakes which we make while deciding about the investment. So I just enumerate what are the mistakes that we make by making investment. First mistake is investing without understanding. We have to understand the intricacies of the financial products before we invest. Obviously, then only we will be able to buy the best product in the market. Second, lack of patience, short-term focus. As you know, most asset classes need a long-term approach in order to generate good returns. So we need to patiently wait through the various ups and downs of the cycles. Third is high investment turnover. Our psychology is that we do too much of chopping, changing our portfolio off and on. Now this kills the returns because we end up paying more brokerages and more fees. So, and also the short-term capital gain tax is always higher than the long-term capital gain tax. So in most of the cases, we need to give some time for our investment to grow. Fourth is attempting to time the market. Third is say the timing the market is a fool's game. Whereas the time in the market is your greatest. The proper timing of investment. And here comes the importance of SIPs, which are useful as they bring in financial discipline and average out the cost of purchase, eliminating timing discriminations. Then very important mistake that we make is putting all eggs in one basket. Diversification is one of the key principles in investing. This strategy helps us to minimize volatility and maximize returns. Then, of course, many times our investment is carried away by our emotions, based on our biases. It is said that if you can't control your emotions, you can't control your money. That's Warren Buffett has said. If you can't control your emotions, you can't control your money. So it's better that we should not get emotionally attached to our investment and be very objective and rational in dealing with them. Then refusal to cut losses. Friends, it is very simple that if you are making losses or if you are making a mistake, we should cut our losses as quickly as possible. Otherwise, we will go on adding to it, and it will be a disadvantage for us. Unrealistic expectations. This normally comes when we have witnessed a black swan event like markets doubling from last year and expected to deliver similar returns year after year. As they say, the returns are never guaranteed. So we have to understand this. They say life does not provide any warranties and any guarantees. It will only provide us the opportunities to connect them into realities. So we have to understand that. Then next is following the crowd. This is also referred to as herd mentality. This is an outcome of uncertainty and a belief that others may have better information, which leads investors to follow investment decisions which others make. Now, such choices often lead to bubbles and crashes. And last is learning from wrong places. As you know, there is a lot of information available from various sources about investment. Many experts will come on TV and channels and give their opinion. And of course, internet is there, Google is there. All these we should not blindly follow. We should do our own research. We should also take the help of SEBI registered investment advisors like our guest speaker, Shepherd Hill. So, and these are all the mistakes that we make while taking decisions about investing. Now, to sum up, as Morgan Housel says, money relies more on psychology than on finance. Be aware of these mistakes which are common and then try to avoid committing them. Now, more of such information will be given by our speaker. I just explained the flow of the meeting to today's meeting. After my speech,
Hemas uncle, we can't hear you.
can't hear me? Hello?
We can hear you now.
What is it? Why? So everything is, you have not heard so far?
No, we've heard most of it.
Continue, Hemas, continue.
I don't want to repeat now anyway. Sorry if there's some disturbance on the line. So this is the problem with Zoom. So now by this opening remarks, now it is time to introduce our guest speaker. So I invite our committee member, Mr. Kamraj Lakrawala, to give introduction of our guest speaker. Kamraj?
Hi. Good evening, everyone. So Rishi Gupta is a managing partner at the Shepherd's Hill Group, Pune. He is a Stanford University alumnus and a former private equity professional with more than 15 years of experience in the capital markets. Shepherd's Hill Group was founded in 2011 and provides SEBI-registered advisory, PMS, and AIF Cat 3 services. Rishi began his career as an engineer, including a stint at Pune's Forbes Marshall Group. During this time, studying engineering at Stanford, Rishi took a few courses at the business school and his interest in finance was kindled. He followed this up with a full scholarship in his MBA Finance at the University of Maryland, College Park. After business school, Rishi joined a prestigious private equity firm in Washington, D.C., where he spent 4 years as an investor, investing in clean technology and environmental-focused companies. Rishi was one of the first investors to invest in India's electric vehicle space when his company invested in Riva Electrical Car Company in Bangalore. Rishi has worked with CEOs and boards of a number of private equity companies as an investor and stakeholder. In 2011, he decided to move back to India to start his own investment firm, as he felt that the opportunity in India was extremely attractive and has been at the helm of Shepherd's Hill Group since then. Shepherd's Hill Group was founded on the belief that the teachings of Benjamin Graham, Warren Buffett, and Charlie Munger could be profitably applied in India. Shepherd's Hill now has a 10-year track record of investing in India's public equity markets and providing investors a net average of 20% per annum investment returns. And as a fund manager, Rishi manages more than 100 crores of client money for clients in India as well as across the world. Ladies and gentlemen, I have the pleasure to invite such a versatile personality to enlighten us on the topic of where not to invest. Mr. Gupta, the platform is yours.
Thank you, Kamrad. I think I'll share my screen, so please tell me if you can see my screen. You'll have to disable, I think it's showing disabled screen sharing, so whoever has the control would have to share that with me.
Rishi, it's enabled. You can go forward.
Can everybody see the screen?
Yes, yes.
Yes.
Okay, Thank you, Kamrad. Thank you to the chair. Thank you to WZCC for inviting me. It's a pleasure to be here. Before I start, let me just read a standard disclaimer because we're a highly regulated industry. So let me just read our standard disclaimer before I begin the presentation. While Shepherds Hill and I are registered with the Securities and Exchange Board of India, SEBI, to provide investment advice, this talk is for informational purposes only. You should not construe any information or material from this talk as legal, tax, investment, financial, or any other advice. Nothing contained here constitutes a solicitation, recommendation, endorsement, or offer to buy or sell any securities or financial instruments in India or any other country. All content in this presentation is information of a general nature and does not address the circumstances of any particular individual or entity. This is a general talk about savings and equity investing in the public equity markets in India. So, when people say that a fund manager or stock market expert is talking, the first thing that pops up in most people's minds is, tell me what the next multi-bagger is going to be, or give me a hot stock tip. But let's talk about something more important than an individual stock tip. Charlie Munger, who some of you may know, is the partner of Warren Buffett at Berkshire Hathaway, which is a large investment company based out of the US. He has a famous statement about not doing things that will hurt you. He says, tell me where I'm going to die and I'll make sure that I never go there. Now, for a man in his 90s, that's a funny statement, but the thought or the concept behind it is the concept of inversion. If we invert a problem, we are more likely to end up with a more robust solution to that problem. Someone else who talks about this is fictional, but his powers of reasoning and deduction are as good as any real person. Sherlock Holmes says, and I think I'm paraphrasing here, but he says, if you eliminate all the impossible options, then what you are left with is the truth. So similarly in investing, we need to try and eliminate all the bad options. And then what we will be left with are the non-bad options. And if we work with these non-bad options, then we will significantly reduce the chances of failure, both at the stock pick level as well as the portfolio construction level. So this is an extremely important question to ask ourselves, where to not invest. And I would recommend any investor who is starting out should start here. A secondary question we need to address is who should or should not invest. Now we need to look at ourselves, our context, our situation, and answer a couple of questions. Should we be investing in equities at all? And if we invest in equities, should we be doing it ourselves actively, or is this best delegated to a professional like an investment advisor or fund manager? And before we can answer these questions, we need to get clarity on something called time horizon. So I like to think of time horizon as the time period for which an investment can be left undisturbed. That means if you're investing in an asset or an asset class, for how long can you leave it there without prematurely withdrawing it and letting it season? So to help us think through this, let's divide our savings into 3 buckets. And I'm specifically using the word savings because we're not talking of leveraged investments. We're not talking about borrowing to invest. This is our hard-earned money that we have saved, and we want to invest a portion of that. So let's divide our savings into 3 buckets. Bucket number 1, the immediate bucket. Bucket number 2, short-term, and bucket number 3, long-term. In terms of time period, the immediate bucket would be around 0 to 6 months. The short-term bucket would be 6 months to 2 to 3 years, and the long-term bucket would be 3+ or preferably even 5+ years. So first, our task is to fill up bucket number 1 with money that we will use for expenses over the next 6 months. There's nothing much to be done with this bucket. We just leave it in a bank savings account, and that's it. Once this bucket is filled, we can move to bucket number 2, which is the short-term bucket. we have to fill this with money for large expected expenses over the next 2 to 3 years. So, this could be a wedding in the family, could be a foreign trip, it could be a new car, things like that. Here too, there is no need to take any undue risks. We need to just pick 2 or 3 bank fixed term deposits and leave it at that. Some advanced investors can look at debt funds and debt securities for this money, but it's much, it's much better to be safe with this money than to reach for an extra point or two of interest. Once these 2 buckets are filled, then we can move to bucket number 3. Now, depending on whether you're a conservative investor or, if you are a conservative investor, then these buckets will be a little bit larger in terms of time period and the amount of money you put in them. And if you're less risk averse, these first 2 buckets will be a little smaller. But the idea is that these first 2 buckets are a cushion and will allow you to then move the overflow and the surplus into bucket number 3. And of course, as life goes on and life events happen, you can move the money around. You can move money from bucket 2 to 1 and 3 to 2 and add to the whole. But the idea is to get to bucket number 3 because this is the bucket that gives us clarity on the asset class and the time period. This is the bucket that can be invested in higher yielding long-term assets. And one thing that thinking about our savings and investments in this way does is that it eliminates a lot of the noise that's there in the financial market. So you hear about debt funds and hybrid funds and balance advantage funds and arbitrage funds. And if you think about it this way, then we get much needed clarity and focus on what is the right product fit for us. And the main reason we think about time horizon so carefully is that especially equities is a very volatile asset class in the short term. So, and this volatility can be stressful, it can be harmful. Some short-term investors even see it as a risk, correctly so. And by having this bucket number 3, by having this time horizon, we are essentially taking out the effect of this short-term volatility on our portfolio. We are neutralizing the effect of this short-term volatility on our investments and also on our decision-making. So at this point, we are now ready to eliminate some options from consideration for bucket number 3 for the long term. Straight off the bat, eliminate all fixed income securities for the long term. And the reason we do this is because over that time horizon, over 3 and 5+ years, fixed income securities are highly exposed to inflation risk and interest rate risk. And even if you try to invest in short-term fixed income securities and try to roll them over time, you will still be exposed to reinvestment risk. So fixed income securities is out. As far as real estate and gold goes, in some specific circumstances, it could be okay. But in general, in my opinion, for the long term, as a large part of the portfolio, these are not ideal. So now we have some clarity on time horizon, which is long, and we have some clarity on asset class for the long term, which is equities. And we need to now look at who should or should not invest, and we need to look at ourselves for that. Let's divide people or investors into 4 categories. Category number 1, I have a day job, I'm busy, I know that I have to invest for the long term, I know I have to invest in equities, but I don't have the time or the inclination, and it's a necessary evil. Category 2, I do enjoy investing, I like making the decisions, it gives me a bit of a high in terms of the activity, the element of chance excites me, I like trading, I like being busy with buying and selling, I even like discussing stock tips, at social gatherings. Generally, it's an enjoyable activity for me. Category 3 is similar to category 1, but here the inclination is there, the passion is there, and more importantly, the training is there. So maybe some finance and accounting training is there. I could be a chartered accountant or an MBA in finance, and I'm willing to put in time in the evenings, on the weekends, and manage my own portfolio. Category number 4, this is the group with the most time on their hands. They are willing to learn, read, research, go up the learning curve. And so this could be a graduate student, it could be a stay-at-home spouse, it could be a retiree. So broadly speaking, these are the four categories of people. Categories 1 and 2 should not be investing directly in the equities markets for different reasons. Category 1, because there's no time or inclination. Category 2, because I would not recommend this temperament for this kind of activity. As a hobby, as fun on the side, it's okay. You can set aside a small amount and do it if you enjoy it. But you should not be investing your hard-earned money in your family's life savings if you fall into this category. Category 3 and 4, certainly they can look at it and try to invest themselves. One final thing we need to do before we get into the details of what we should avoid when we invest in equities is that we need to set expectations in terms of what is the return we can get when we do this activity, right? And to do this, let's look at what the Nifty index has done in the last 10 years. And the Nifty is a proxy for India as a whole. It's the top 50 companies price index. So you can see the numbers here, around 4,000, around 5,000 10 years ago, close to 17,000 now. People are talking about all-time highs. But if you look at the annual compounded rate, it's 13% over 10 years. So this should set a bar for us in terms of expectations. The Nifty is the combined expertise, opinion, and knowledge of the entire country. So it needs to be viewed with a certain amount of respect, right? And as an active investor, your job is to beat the Nifty. If you're just going to match it, then you might as well invest in an exchange traded fund which mimics or copies the Nifty. The expense ratios are very, very low for those, and there's no time and effort involved. But if you're going to do this actively, then you have to beat the Nifty. And like I said, this is all the knowledge combined of the whole country. So as you begin this process, you have to start with a good amount of humility. The advantage that we have as small or individual investors, because we are investing a few lakhs or a few crores of rupees, and the entire market is multi-trillion-dollar worth. So that is an advantage. A fundamental rule of investing is that it's much easier to invest smaller amounts of money than larger amounts of money. And our job is to find moments or pockets of inefficiency in this very, very large market. There is no free lunch, nothing is guaranteed. And also, just like democracies, investing in equities is the least worst option. So certainly you're exposed to risk over this time period, over the long term. But if you were to invest in other things, you'd be even more exposed to risk. So, so looking at the Nifty sets our expectations, sets a bit of an anchor, and don't expect to get something very, very different from that. And by setting this reasonable expectation, we do one more thing, which is we prevent, we stop ourselves from getting tempted to reach too far. There are sometimes things will look very, very attractive, but there might be hidden risks that you might not be able to see. It might be too good to be true. So just taking a look at the overall picture helps us. One other advantage we have because we are small is that there are lots and lots of companies listed in the market, thousands and thousands of companies, and all we have to do, I say all, but what we have to do is build a portfolio of around 10 to 20 companies that we have to select from the thousands and thousands of options available. These options are larger for the smaller investor. If you're an institutional investor, you're managing tens of thousands of crores, then your option set, your universe reduces, right? So your job is easier because of this reason. So now that we have set our expectations, we are ready to jump into where we should not invest and what are the areas we can look at to avoid. By no means is this an exhaustive list, but these are some of the more important areas that you can look at. The first area we look at to avoid is companies that have low returns on assets. And return on assets is nothing but the total net profit earned by a company divided by the assets that are deployed in its operations. And If a company is inefficient in deploying these assets, it could be a factory, it could be working capital, it could be raw material, then it will have low return on assets. And remember, the whole point of a capitalist system is to squeeze out as much value as possible from each rupee or each dollar. And if the company is doing that inefficiently, then the money is fungible, it's going to move somewhere else. So we need to avoid these companies. As a small investor, we what will end up happening is that we will avoid many companies that have very heavy capital intensive business model. So in our case, that is a desired result. The next area we look at is companies that have high levels of debt. We've seen in the pandemic, how quickly the business environment changes, the environment around the company changes. And when companies have high levels of debt, they have high fixed and inevitable payments in terms of the interest. And that makes companies very inflexible. So when the situation changes quickly, they're not able to respond as quickly. And they can be a source of weakness in a portfolio that you would construct. Now, at a personal level, we all know that high levels of debt can be dangerous. And mostly this is true even when it comes to companies. As a natural consequence of the first two areas that we want to avoid, we would need to avoid banks and financial services industries, because banks have low return on assets and they have very high leverage ratios. There is one small exception, I'll talk about that in a minute, but banks essentially are among the highest leveraged companies that are out there. This is because they take on high levels of liabilities on their balance sheet in the form of customer deposits. And because of this high leverage, when the economy is doing well, bank operations and bank results look much better and are much better. And when the economy is doing poorly, we've all seen non-performing assets rise and banks do much more poorly. So banks in general should be avoided, but the advanced investor can look at banks as an option, mainly because there is no other way to run a bank. I mean, the business model is, revolves around the leverage that they take on. But even professional and advanced investors know that the levels of visibility in terms of the data that comes out of banks are low. Analyzing it can be pretty complex and difficult. Banks are constrained by the volumes of data that are there, and they're also constrained sometimes by the regulator, and they're just following the regulator and don't provide any further information beyond that. For example, if an analyst is looking for granular line-by-line data of all the loans that have been given by a bank, that is not available. So banks in general, for most investors, I would say should be avoided. The next one we look at is companies that have high operating leverage. And this is nothing but a company that has high fixed costs. These could be legitimate fixed costs. A company needs to put in plant and machinery so that it can try to deliver products and services to grow revenues, and which is all fine while the revenues are growing and increasing. But when the situation changes and revenues dip, then profitability can reduce and even go into negative territory. So companies that have high operating leverage tend to have higher volatility in their operating metrics. And we talked about volatility in prices and the equity asset class in the short term, and we've seen that we can overcome that. But volatility in operating metrics and operations of companies, whether it's short term or long term, needs to be viewed cautiously. Next area is companies that produce commodities. The main thing here is to define what is a commodity. I like to do that from the point of view of the consumer. So if I'm a user of a product and I can switch very easily or effortlessly from that product to another product for a benefit in terms of cost price to me, then that could be a commodity. I'll give you one example at a personal level. So I am a consumer of Amul butter, and if someone came with another brand of butter and said, okay, you can have this at 20% less price, I'm not interested. I'm not going to switch my brand of butter. But let's say I'm booking an air ticket from Mumbai to San Francisco via London Heathrow on British Airways, and I see a deal on Lufthansa via Frankfurt for 20% less, it's not going to take me more than a couple of minutes and a couple of clicks to change my itinerary. So, this is a small personal example, but the job of the analyst is to look at it company-wide and look at the products and services and make a judgment call whether that's a commodity or not. One exception to the commodity rule could be companies that do produce commodities but have a significant cost advantage on the supply or production side. In that case, you'll see that profitability can be sustained and can be grown over time. But this is a relatively rare occurrence. So in general, commodities should be avoided. There are some companies and sectors where you will see sustained profitability levels despite not having this cost advantage. And those sectors tend to have, especially in India, some amount of cartelization. Following on from the commodity theme, companies that have high competition and high levels of threats from substitution and obsolescence is an area to be avoided because, for example, if you're looking at a newspaper company, it's not enough to just look at other newspaper companies of the same language or the same geography, but you also have to look at the effects of digital marketing, digital advertising. What are advertisers doing in terms of moving from one channel to the other? And because our time horizon is long, sustained levels of such kind of forces can be a source of strain and stress on the operations of any company. So if these forces are present, it's much more difficult to look out 3-5+ years and take a call on whether profitability will be sustained, will grow, etc., etc., etc. So it's not enough to just look at this year's earnings and next year's earnings. You have to look out a little further, and the more these forces are present, the more difficult it becomes to make that judgment call. So these should be avoided. The next area is not so much an area of investment, but it's about time management and the time we spend on researching and learning about different companies, and it has to do with market capitalization of companies. So I'm sure many of you know, but I'll just define it. Market capitalization is nothing but the total shares outstanding multiplied by the share price. And so this is the total equity market value of a company. SEBI defines large caps as the top 100 companies, mid cap as the next 150 companies, and everything else is considered and defined as small cap. So if you're viewing or if you're watching finance TV or business TV, or if you're reading research reports from sell-side analysts, or if you're on social media reading about these companies, you will notice that 80 to 90% of the time and material of these discussions is related to the top 250, the large and mid-cap companies. And this is not very surprising because 80 to 90% of the money that's deployed in the markets is deployed in large and mid-cap. But I mentioned earlier, we are a small investor, so we don't need to blindly follow what everyone else is doing. We need to be an equal opportunity research analyst, which means the time we spend on researching a company, on trying to pick it for our portfolio should be directly proportional to the merit of the idea itself. Because once we pick it, let's say we have a 5% allocation to the portfolio for that company, it really doesn't matter if it's a very large company or a small one. What matters is, will it grow over time? Have we gotten at the right price, and all the other fundamental issues. So what will happen when we do that is we'll become a flexi cap portfolio. So that could mean that 50% of our portfolio would be small cap, but that's okay as long as we've chosen these companies on their merit. One other advantage of doing it this way is that for equally good ideas, larger companies take much more time to analyze because they have many more operations, many more joint ventures, subsidiaries, international operations, businesses, competitors versus a smaller company. So in terms of efficiency and time spent, you could end up with a position in your portfolio, assuming you find a good idea, you could end up with a position in the portfolio for much less time when you work with a smaller company. The next is public sector units, and two reasonable people can absolutely have a difference of opinion on this. And I am well aware of the high quality of men and women who work at PSUs and the leaders of these companies, the bureaucrats. But what's the issue here? As an analyst, as an investor, what's the issue? And one very important thing to look at when you study a company is the quality of management and ownership of a company and the durability of that management and ownership. So, for example, if I've made the judgment that CP Gurnani or Aditya Puri is an excellent CEO, then I want some level of assurance that that situation, that condition will continue for the time horizon that we're looking at. Or if I've made the call that Anand Mahindra is a good chairman, and I know the kind of high quality decisions that will be made under his chairmanship, then I want some assurance that that situation is going to continue for a number of years. And that is not available in a public sector unit. The government changes every 5 years, and bureaucrats also change relatively quickly. Now, that's not to say again that these are bad companies by any stretch of the imagination. I'll give you an example. State Bank of India at most prices would be a better investment option than 80% of the available options, right? But our bar is higher. I mentioned we need to pick 15 companies for our portfolio out of thousands. And so our bar is less than 1%, 0.3, 0.4% is the selectivity we need. And the 20% cut that SBI makes is not good enough, right? So PSUs, in my opinion, just best avoided. The next one we look at is pretty straightforward. IPOs. These are very highly marketed events, and anything in the financial, in general, but in financial markets particularly, if something is such a hard sell and is marketed so heavily, then we need to avoid it. These markets are also very short-term oriented. So I was reading an article in Business Standard yesterday that said that between April and July this year, more than 50% of shares that were allocated in IPOs were sold on the day of listing. So we've already seen that we want to be long-term. We're using bucket 3. So there is no need to get into a trading market. If you do like a company that's been listed, wait for a few years, wait for 3 or 5 years, and then take a look once the hype has died down. It's a trick I like to use when I look for ideas is I look at companies that were listed 5 years ago and see if something interesting comes up. Many times when you see the price graph in the 5 years after listing, you'll see it goes sideways or worse. The next is a vast area by itself. I mean, we won't have time to get into all of these areas in much detail, but I'll just quickly run through some of these. We need to look at the investments that a company makes, whether it's debt or equity, the rationale behind it. We need to look at the loans and advances line item. What kind of disclosures is the company making? Is there a history of these loans and advances being written off? We need to look at joint ventures and subsidiaries. Some companies will have joint ventures where the promoter is a separate, a shareholder in that, and some of the value can get taken out that way. We need to look at related party transactions. So this could be rent, it could be royalty, it could be salaries to promoters. In the Indian context, you can have cousins or second and third generation people who are being paid high salaries and are not bringing that kind of value to the table. We need to look at, I like to look at preferential allotment of equities or warrants and see if there's a convincing rationale for them, because the general rule should be that, if companies need to raise capital, equity capital, it should be a rights issue, so minority shareholders get a chance to participate. We need to look at capital allocation. If a company invests in businesses that are in no way related to what they're actually trying to do, that's a flag, red flag. We need to look, there are companies that invest in sports teams in other countries. If you see that, that's a flag, red flag. Weak communication and transparency for some of the smaller companies. You can give them a pass on this because they may not have investor relations teams. But for the mid and the larger size companies, if they're not transparent, if they're not having regular quarterly calls, their disclosures are not of a certain standard, then we need to look at those. So to wrap it up, don't expect perfection. None of the companies you look at are going to pass all these criteria with flying colors. It's not an exact science. There is no single right answer. So you can have two people following the same philosophy and framework, and because you're selecting only 15 out of 5,000, you could end up at completely different portfolios. There is no right answer. The best investors make mistakes. I like to give the example of Warren Buffett, where he for a long time he said, don't invest in airlines, you lose your money. Then when the prices were very, very attractive, he bought airlines, and then when COVID hit, he sold all the airlines, right? So when the circumstances change, when the facts change, you got to be flexible and act accordingly. The flexibility is within reasonable constraints, and what I've talked about are some of those constraints. But you definitely need to be flexible because it's more a craft than a science. You need optimal diversification, so you can't have 1, 2, or 3 companies because that's too risky if something goes wrong with one of them. But there's no need to have 100 companies because, like I said, you can just invest in the index very easily with very little time and effort. So if you're going to try to beat the market, the diversification level has to be optimal. And then price. This is another whole vast topic. Almost any company is a good investment at a very low price, and almost any company is a bad investment at too high a price, right? So hopefully this helps some of you think about your savings and investments. And yeah, that's it from me. Thank you.
Thank you, Rishi. Mehzad, can you stop sharing the screen?
I'll stop sharing my screen, yeah. Okay.
Okay, so thank you, Rishi. I think you have covered the whole investment matter in such a great detail that person like me who is very much unaware of the things have learned a lot from your talk today. And I'm sure all the participants also must have got a lot of information about the topic. Now we leave it open for the question and answer. So if you have any questions, either you put on the chat box or our moderator Mirzad Mutafaram will take care of the question and answers.
Thank you, Demas uncle. So we've got a few questions. Okay, so Rishi, the first question is that there are many fintech brokerages today. Please advise which type of brokerages to avoid, and are brokerages affiliated to banks generally safer?
The largest brokerage in the country is not affiliated to anybody, Zerodha. They have 20% of the market. It's just like any business. I mean, there's no general rule to knowing whether someone is honest or not. You have to do your work and research and pick. So on this call, I can't name names in terms of what you should, who you should work with. But there are the better ones and there are the not so good ones.
Okay, thanks, Rishi. The next question from Mr. Adel is, what is your view? Sorry, 1 minute. What is your view on mutual funds and index funds as a way for small investors to diversify?
Yeah, absolutely. I mean, if you go with a good mutual fund house and you pick one large cap, fund and one maybe mid and small cap, that's more than enough. They do a good job given the kind of money they invest. I mentioned in my talk that they're investing lots and lots of money. So they have a certain ceiling in terms of what they can do, but they're less risky in the sense that you won't end up with, an unscrupulous fund manager or somebody who doesn't know what they're doing. So the big names, the big brands generally are okay. it's not completely without risk. I mean, I don't know how many of you heard of Franklin Templeton and their debt funds. And Franklin Templeton is a very big name. But they went awry a little bit. So nothing, like I said, nothing is guaranteed. But if you do your research, you can pick a couple of fund houses and diversify that way.
All right, thank you. The next question is, are we in a liquidity-driven equity bubble, both globally and in Indian equity markets? And when do we expect the correction to take place?
Yeah, we at Shepherd's Hill, we don't do any macro analysis, any macro predictions. You saw my whole talk was about specific companies and micro level information and frameworks. If we invest in good companies, it doesn't matter what the macro economy will look like over 5 and 10 years, we're going to be fine. So I'm sorry, but I don't have any view on bubbles. I don't have any view on next 6 months or next 18 months.
All right. What is your view on mutual funds versus ETFs?
You can split it. You can have a Nifty ETF and one mutual fund. I mean, ETFs could have, depending on which ETF you pick, you could have a lower expense ratio because the ETF, there's no active management involved. You don't need those research teams to do it. It's just indexed to whatever whatever it's indexed to, and so expense ratios for ETFs are lower, and you can go either way. I mean, there's not going to be much of a difference between those and, let's say, a large cap. I think historically, if you look at all the large cap funds, they have beaten the index by 1 or 2 percentage points. But as that industry grows, it's going to be harder and harder for them to beat the index. So index or large cap fund, very, very close.
All right. What are your views on new tech IPOs, especially Paytm?
I gave my views on all IPOs. So you heard my views on all IPOs.
Okay, fine. Very candid. All right. What is your prediction on the current markets? Do you think the highs shown are correct or just speculation?
That's again a market question. So I'm sorry. I'm sorry I'm not being of much help here with many of the questions, but macro, there are no comments from me. Don't worry about whether there's a bubble or not. Focus on the investments themselves, and good investments will do well beyond any bubble and beyond any crash.
Okay, fair enough. The next question is, what is your thought of investing in REIT funds as a way of investing in realty, especially from taxation perspective?
REIT funds, if they are done through the alternative investment fund route, you could look at that. Taxation is beneficial because I believe if it's Cat 2, there is a pass-through on that taxation. But for tax questions, you'll have to talk to your tax advisor. Certainly, REITs give you more diversification. So if as an individual, you already own the house where you're living, and if you try to buy another house, that becomes a very large part of your portfolio. And if a REIT allows you to invest smaller amounts of money and get that diversification, you could do that. REITs also invest in commercial real estate. So if you want some exposure to that, I mean, right now it's a tough industry, but if at some point you do want exposure to commercial real estate, you can do that as well through a REIT.
All right. What about gold sovereign bonds issued by RBI?
I'm not so sure. I mean, I don't know how easy or difficult it is as an individual to do that. If somebody has a website or a tool where they're able to do it with not so much effort, please share it with me, because I don't think I'm aware of something like that. In theory, and RBI has been talking about it, the government has been talking about it, but till recently, the minimum was for these kind of products was very high, I think 1 or 5 crores. And so for someone who wants to invest just a little bit of money, I'm not yet aware of a good practical option.
All right. The next question is, what is the best source of information on companies where you choose to invest? Information on governance is not easily available for small and mid-cap companies.
Yeah, it's very hard to get information on governance per se. You have to develop that, I guess, that sense about a governance of a company, and you get that through different ways. You can get it through the numbers, you can get it through interactions with the management. You can go visit a company at their AGM and talk to the board or talk to the senior management, get a sense of how open they are. You need to look at how they treat minority shareholders. I gave a couple of examples of how you can do that, but you're not going to get, I mean, even agencies like CRISIL or CARE or these, rating agencies, it's not easy for them to flag a company as good governance or bad governance. There are a couple of organizations that are trying to do that now, where if they see something that's happening that's against minority shareholders, they put out a paper on that. And I think recently we heard of one instance where the Eicher Motors CEO's salary was an issue, and some of these governance organizations came in and said maybe that should be voted down. But sometimes the focus is on maybe not the right things. If the CEO has actually taken the company to greater heights, then maybe they deserve that higher salary. And then a little bit of the socialist mindset comes into play, and there's a push and pull between that. So these are all very qualitative issues, and each investor needs to take a call for themselves. What is good governance? What's not? There are some clear examples at the extreme ends, but in the middle, there are gray areas, and you have to just, it's not a perfectly clear and demarcated world.
All right. Could you throw some light on exchange traded funds, index funds, and SIP?
I don't understand what throw some light means, but
Maybe explain what is it.
yeah, I mean, Mr. Barucha explained the SIP. You invest once a month, or invest at regular intervals, instead of putting everything as a lump sum. Some people are a little bit wary that if there's a crash, then and I've just put in money, then I will lose a lot of money. But nobody knows what's going to happen. So my view is that as far as SIPs go, if you have a lump sum that's sitting in an FD and it's meant for 5+ years, you need to immediately deploy into equities. It doesn't make that much sense to go SIP. SIP is for maybe salaried individuals where you're being disciplined about saving 5, 10, 20% of your salary, and you're moving it. So the moment the salary check comes in, you have an ECS that takes it to the SIP. ETFs, it's just an index, or it's an index of something that you want to mimic. What are the third thing? ETFs, SIPs, and
Index funds.
Index fund.
ETFs, yeah, index funds is trying to do what ETFs are doing, but you're doing it through a mutual fund where there is maybe some level of rebalancing and activity. So there's not that much difference between those two.
All right. I think this is a question you like. What about Bitcoin? Is it interesting in them, since now the government is
just taking there are much smarter people than me who have talked about Bitcoin. So I don't have any Bitcoins, and I don't buy it for clients. The regulation in India itself is still very nascent. So I don't think the government is clear about is Bitcoin good or bad. Until that happens, it's a little bit risky to have too much money in Bitcoins, because if the government wakes up tomorrow and says that no, Bitcoins are banned, then you're stuck. And if you're talking about it as a currency, it's non-existent. I mean, I don't think maybe there are some coffee shops in San Francisco that accept it. I think Tesla was accepting it for some time. But I don't know. Do you guys know of any Indian retail operations that are accepting Bitcoin? I haven't heard of any.
No,
Not really, no.
no, nobody accepts.
I think PayPal is accepting Bitcoin. Not Indian. But...
PayPal, yeah.
Okay. The next question is SGB one of the best way to invest in gold?
Yeah, I'm not an expert on sovereign gold bonds, so I don't think I should go much deeper than what I already said.
All right. The next question is, can we purchase from ICICI Direct?
Purchase what?
Okay. What site should we look to screen stocks as per our requirements?
Screener.in, SCREENER.IN.
All right. The next question is, how long do we wait to get out of an investment if it is not doing well?
Yeah, I think Mr. Barucha talked about this in his opening remarks, and I'm not sure I agree. The one point I would disagree with him is that just because an investment is doing poorly, you should not sell. You have to look at the fundamentals. Has something actually changed? Is there something that the management did that was not fair to minority shareholders? Was there a transfer pricing issue? Was there something, or is there a lot of competition coming the company's way? So you have to look at fundamental issues that may have driven that price. So the market generally is very efficient, and there are lots of smart people who are investing. And if the price drops, there most likely is a good reason why it has dropped. But you have to take a look at that fundamental reason as opposed to the price itself. So if you've invested in a company and the price has dropped because COVID has hit, and you're not an airline, you're not a tourist company, you're not, you don't have a restaurant, then and you take a call that, okay, in 6 months, 12 months, my customers are going to come back, my clients are going to come back, which happened with information technology in a big way, then there is absolutely no reason to sell, because it's a macro factor that's dropped the price, and you don't have to sell. So that's what I would say about selling when prices drop. Don't let the price be the signal. Look at the fundamentals underlying the price.
All right. Thank you so much, Rishi. I think that's all for the questions for today. Temas uncle, let's move on.
I think Rishi has answered very well all the questions. He has been very candid, very upfront in his talk, and he's tried to be as ethical as possible, I must admit. No promises, no assurances, nothing of that sort. No. So this reminds me of one sentence, that he who is slowest in making a promise is most faithful in his performance. So I'm sure Rishi and his firm is really faithful to the investors and very efficient in performance. With this note, I think we are coming to the end of this today's session. And before we say good night to everybody, I will invite our committee member, Farokh Batena, to give a vote of thanks.
Thank you. Thank you, Temas. Thank you very much, Rishi, for accepting the invitation and coming today to give this very enlightening talk on this a topic which is not such a common topic, because as Temas said in the beginning, whenever you have these kind of sessions, you are always talking about where to invest, which are the right portfolios to invest in, etc. But you picked up a very interesting topic, where not to invest. And I think in very simple terms, you have explained to all of us your thought process behind what you said are the areas which we should be cautious about before we decide to invest. You have your talk was so it engaged everyone so much, which could be also noticed, or you would have seen from the number of questions which came up at the end of your talk, which you answered really, as Temas said, very candidly, without and I mean you maintained this thing that ethically right answers, let me put it that way. So thanks a lot. Thank you very much. And I would also like to thank all the everyone who has joined into today's webinar and participated in today's webinar. Thank you, everyone, and have a good night.
So we are very happy to have participants from all over. It's not only from India, but from abroad also. So we are very thankful to them and wish to continue the same tradition as and when new webinars are put up by WZCC Pune chapter. Thank you, Rishi, once again. And thank you, everybody. Good night. Have a nice time. Be safe. Be kind. Thank you.
Bye. Bye.
Thank you. Bye-bye.
Thank you. Thanks.
Bye-bye.